And what I'll do now, I'll give a brief overview and summary, my take on these two papers together. And after which, I'm going to be inviting our community bank expert to share his comment. And I see I see at least there is a question come in my chat box. So keep them coming. After we have spoken, Jim and I will moderate the Q&As, and we'll love to have more questions from you. All right, so back to these two papers. Local lending and access to credit. I mean, there's nothing new about this topic per se. We have been, on the research side, we have talked about it for a long time, that how do small banks or large banks, what does it mean in terms of access to credit in the local market? But both these papers have one very interesting angle, in my opinion. There's a lot there, and I have 11 minutes. So a lot of interesting stuff in both these papers I'm going to leave aside and jump right into a common theme. Two interesting papers and one big question. What role do small banks play in affecting real outcomes? That's where both Eric and Dane come to at the end of their analysis. And if you look at a big picture analysis, what they're saying is small banks, they shift the supply curve of lending outward. That's a common theme in the sense that in Dane's case, it's the FHLB access, funding access. And effectively what happens is that you have the amount of mortgage credit, the price of credit, they indicate that there's more funding available and at a cheaper price. And Eric's paper says that, hey, it has, in his work also, there is, of course, a real outcome, and he pushes it a little bit further. And his paper talks about some distributional implication. In fact, what I like about that is distributional implications across generations. So if you have a lot of small banks, you get a lot of credit, you can invest in the human capital of your children, and maybe in the next generation, you have this upward economic mobility. And then both these papers have this small bank, large bank at the core of their analysis. So it's also about the competitive effect of these markets. So there's a lot to like about both these papers. Now, I just have one presentation of finding and two comments. So let me start from the second paper and what Dane's paper has shown us, that you have FHLB support. So there's an access of wholesale funding, and that expands the supply of credit, as I was talking about on the previous slide. And this expansion of credit is stronger for small community banks. So if I take that analysis, essentially we're looking at some government support, and through the supply of credit, it's reaching the mortgage market in the local market, and especially for small banks. And now if you look at and juxtapose the two findings together, Eric's finding is that when you have a lot of small banks, more credit is flowing to low-income borrowers, and effectively it improves intergenerational mobility. So when I was reading these two papers together, a natural question that arises is that, hey, is this link a possible link where you have government support through FHLB in this case, and it goes through the lending market, the banking market, to economic intergenerational mobility? So in fact, I'm just pasting the two results together, and it's just one big picture question. And of course, both these papers are looking at different data sets, and so there are some differences. And we cannot yet draw that conclusion from combining the two results. But why this is going to be interesting, some food for thought, is that we have learned a lot in economics literature on government support directly jumping to intergenerational mobility, or government support of different kind helping low-income borrowers, for example. If it goes through the banking market, if it is going through the small community banking markets, then we have learned something really interesting. and it's going to be a challenge. So I'm throwing it out to both Dane and Eric to draw that connection, and to everyone on our in our session today. So that's my first thought. Now, I'll go to each paper, and I have just one comment for both authors that hopefully should help in positioning the paper a little bit better. So let me start with Dane's paper again. And what I saw in the paper and what you saw in the presentation is essentially what's good about FHLB when it comes to providing credit to via small banks. Now, that's on the real side. If we look at the financial side of this business, especially in the recent, I'm talking about 2015, 2016, subsequently, when you had a lot of regulations, liquidity coverage ratio for banks, and money market mutual fund reforms in 2016. The net impact of both these regulations was that banks, especially large banks, they found it very attractive now to borrow from FHLB and less from money market mutual fund. Roughly speaking, borrowing from a money market mutual fund is not attractive in terms of meeting the liquidity coverage ratio. So now there are two things happening. One, the large banks are also now actively going to FHLB. And I was really hoping to see some connection on, so how are you thinking about it now, what's going on? Is there a crowding out that a lot of large banks are coming and the small banks? So one is more a little bit of light on that, because large banks are lending from FHLB. But other one is some comment, or at least we need to think a little bit deeply about what happens to this FHLB supplying credit to small banks. What implication does it have on the liquidity risk in the system of this kind? That is, now FHLB banks have pulled back from money market mutual fund, and FHLB is borrowing from money market mutual fund. So what's happening is that now FHLB is taking the money from short-term money market mutual fund and transforming the maturity of that by lending to your small and large banks for longer maturity. So they are taking maturity mismatch. So as a policymaker and as a practitioner or as a researcher, we'll always think about, all right, so what is the welfare implication? Your paper has done a very good job in showing the real side welfare implication by expanding the supply of credit. At least a little bit of discussion on this front about maturity mismatch will be helpful in my mind. Now to Eric's paper. So you saw one of the key points that Eric makes is that, hey, small banks, they are lending to low-income borrowers, and because they have an advantage in processing soft information. So, and I like the phrasing that, look, they know the community. So they know the local barber shop, but they know the local guy, a local contractor. So they feel comfortable lending to that guy. Right? That's a basic idea of soft information. Large banks, on the other hand, they have hierarchical structure and it's a little bit anonymous. So they are mostly driven by the cost advantage. So that's the tension that Eric's result is essentially telling us, that one group of lenders, they have advantage in processing information, and the other group that has cost advantage, large bank. And kind of they're separating out. So the information advantage folks, they're going to low-income borrowers, and the other folks are going to a standard high FICO score and so on. And that's where this result has come from. Now, while I was reading your paper, Eric, clearly I started thinking about what's the new landscape again with these fintech firms. That is, when fintech firms are coming, they are coming with at least the promises that we will reduce the cost. We'll reduce the cost. And so in that sense, in fact, they're competing with the large banks. And that's obvious. For your paper, and in general, what is less obvious is that are these fintech firms also hardening those soft information? We are hearing about all these machine learning models. So what we call soft information, say 10 years ago, need not be soft information today, because somebody has figured out through a fintech model, through some machine learning model, to codify that information. Again, food for thought. There are some papers in the literature that are talking about using these algorithms to reach underserved community. So where I'm going with that is that it's more about essentially asking you that, hey, can we comment a little bit on the future of your findings? Where are we headed for both of you, Eric and Dane? So with that, I will stop here and I'll say one final thing that that I did not go into. Both these papers have done a lot of work on identification. I think it came through. So on that, it's all good. And they have interesting models. And I did not comment on them because they felt pretty reasonable to me. And I just hope that that these comments are helpful to you, Dane and Eric. So with that, Jim is showing me that I have 20 seconds, and I'm really pleased now to welcome our community bank discussant. And that's one thing I really like about this conference. I remember a few years ago when my own paper was there on the panel, we had the benefit of hearing from also practitioners. And later, in fact, we talked to a couple of practitioners. So I'll encourage both Eric and Dane to reach out to them. And today, our community bank discussant is Vernon Hirata, who is vice chairman and co-chief operating officer of the Territorial Savings Bank in Honolulu, Hawaii. When you are speaking from Ann Arbor, Michigan, and somebody from Hawaii, you start dreaming about the weather and the warm beaches there. So welcome, Vernon, and we all are really looking forward to your comments, your thoughts on these two papers. Over to you, Vernon.
First, I'd like to talk about the mortgage loans, and while you thought I was going to talk about this topic, what I'd like to do is actually give you a lesson in a couple of phrases that we use in Hawaii, which are sort of pidgin English, and you can, and I use both of them for each of the topics. And once you get those things, you can use it here when you get to Hawaii. So the first one is make trouble, and I'll use it in a sentence. It's that guy Vernon, all he does is make trouble. So I'm going to apologize to Dr. Mayer because I'm going to make trouble for him. So, but he's fortunate in that he can actually ignore me because Territorial Savings, in his study, he uses banks that have contiguous to another state, and for us, we're not contiguous, so that's one reason to ignore my comments. The second reason is that we're a big bank where he focuses on banks that are $1 billion and less, and we're $2 billion. And then finally, we're a traditional thrift. 97% of our mortgage loans are in residential mortgage loans that are fixed rate. So for us, the way I look at it is the GSEs dominate the residential mortgage loans, and Territorial, and it represents 70% of the market on the conforming loans. So Territorial gets a loan that's in the Fannie Mae or Freddie Mac dollar amount. We take that loan and we run it through the automated underwriting system. So that eliminates the extent of using soft information, because I believe we might be typical of most community banks in which we're going to use the automated underwriting system. So that, to me, might suggest that at least 7 out of 10 loans are not using soft information. So then when you get to then what does that leave? The portfolio loans that the banks hold on to. And portfolio loans are divided by not just people who have subprime credit, but also the property also makes an impact and is not eligible to be sold to Freddie Mac or Fannie Mae. And what I mean by that is, for example, if you have a townhouse condominium in which one of the buildings has a construction defect and the others are fine, for Freddie Mac, that whole property is ineligible to receive a Freddie Mac loan. But Territorial will make a loan on a building that's not impacted by that construction defect. So I would say that it's not necessarily what raises in my mind is the extent to which community banks are actually making loans on soft information. I know he can quantify it, but I don't believe that soft information just relates to the borrower, but also to the property. I mean, so where does that leave me? I think that for economic mobility, I think that soft community banks are further challenged in the residential mortgage market. And that's, for example, I list some factors that I think will, since 2015, are headwinds for those small banks. And therefore, I think that from Hawaii's perspective, from my perspective, it's really not the large banks or the small banks hindering especially mortgage credit, but it's basically the high cost of housing. And I think all of you know what the implications are for states or locations with high cost of funding. So moving on now to the Federal Home Loan Bank. So my phrase there is a sort of make trouble. It's instead that I want to show some aloha to the Federal Home Loan Bank. And what I mean by that is I will start with the what's called the big L, which is liquidity. And I think all the bankers and regulators know that we have a CAMELS rating, and that L stands for liquidity. But the reason why it's even more important for community banks is it is a excellent way of liquefying your residential mortgage loan assets, which are on your books, and you're able to then, by borrowing against it with the Federal Home Bank, help meet your liquidity. And now for Territorial, in addition for us, because we're a fixed rate lender, we use the Federal Home Loan Bank for our interest rate risk. We're able to ladder our borrowings or our advances for maturities that are much longer than a retail deposit or even the repurchase markets or the repos, and that helps us manage our interest rate risk. Now, the reason why for the small banks, I say the small B, the Federal Home Bank is the bank's second best friend. For liquidity purposes, of course, your best friend for small banks are the retail deposits. But for the second best friend is really the Federal Home Loan Bank, because in the situation of a bank that's, say, $250 million or less, they probably are not able to access the repurchase market or the repo market run by the investment banks because they're just too small. So in essence, they're shut out from that market. So what the Federal Home Loan Bank does is allow small banks to be part of the competition, or what I call the big game, which I think everyone knows, and what Dr. Jiang tries to measure, which is the more players you have in the residential in the market, the better the competition, therefore better rates. And so I guess that would be my observations for both of these papers.
Thank you very much, Vernon. That was extremely insightful, and I hope very helpful to both Eric and Dane.